Well, hello again, everyone, and thank you so much for spending your morning with us. You know Morningstar as clearly an investment management firm, and you've heard from our executives, our leaders in our investment management business. Many of you, again, also know Morningstar as an investment research firm, and you may use some of our tools and technology in your advice practice. But what is this behavioral science piece we keep talking about? Well, we actually have a team of PhDs and researchers as well at Morningstar that are behavioral scientists, that are experts, and they work with our portfolio management team. They work with all of us to actually help come up with new tools, new practices that we can put in place to help us achieve our mission, which is to help investors achieve better outcomes. One of the most significant focuses areas of their work is actually working with all of you as advisors, and actually what tools can we provide, what insights can we provide to help support you in your practice. And Regan and I have the privilege of sharing with you their latest work, and that's in your bag is this guide called Simple But Not Easy, keeping with our theme, our Warren Buffett theme. And that's a guide for you that has some of their latest insights, some of the best insights from researchers around the world. And we're going to pull out some practical tools that you can use, hopefully in your practice. And our hope today is that one or two of these may resonate with you and perhaps give you an opportunity to expand out and have richer conversations with your clients. And the reason we do that is because we know your role is so critically important, and advising is so much more than this. It's so much more than a mathematical analysis of risk versus return. And while that's critically important that you're setting long-term goals together with your clients, you're figuring out what their risk tolerance is, you're putting together investment strategies, you're developing a long-term financial plan with your clients, that's only one part of what you do, and you know this very, very well, and we recognize it too. So much of what you do is be a behavioral coach. And we think more and more that we're all going to start as an industry recognizing how critical that role is. And if you go back to Chris Galloway's first presentation and his last slide that had that great illustration of that behavioral gap, we believe there's a powerful combination of building holistic portfolios that people can have confidence in and that are built to last, with teaming up with you as great behavioral coaches to help people stay the course. And if together we can do that as an industry, might we be able to actually help bridge that behavior gap, help people reach their goals, help them have the life that they really want to lead going forward. So again, to be good behavioral coaches, if you think of yourself that way, and we hope you do, think of yourself that way in that critical role, there's certain hardwiring that makes it really difficult for us as investors. If I was your client, makes it really hard for me to stay that course. And this is a part of just the human experience, which was why we call this last session Simply Human. There's certain hardwiring that makes it difficult. And what I'd like to do is just give you a 30,000-foot view of some of those most prominent behavioral biases. And that these will be biases that you will say, I recognize that. I've seen that person walk in my office last week or last year. And particularly then, Regan will come on and he'll share with you some practical tools from our Behavioral Insights team that you can use to address some of these biases. And our thinking here is that for so long, we've been told as investors, or we've been telling investors, set aside emotions, avoid the temptation. Don't read that last article. Don't listen to your brother-in-law at the barbecue. Just set all that aside and just stay the course. But that's incredibly difficult for us to do. And that's why emotions often rule the day. So instead of just ignoring those biases, ignoring the emotions, what we're going to recommend is that we start working with those in clever ways. Again, recognizing some of it is just innate in our humanness. So let me just take you through some of those key biases. Now, the graphic here is to illustrate the fact that after you've put together a long-term plan with your clients, there could be some rocky points along the way, some things that can derail them. And these are what we call friction. The behavioral scientists call friction, let's say, in terms of how we stay the course to reach our goals. And these are 4 common investor biases. There's so many more, and there's more that we've articulated in your guide and also some suggested reading if you're interested in learning more about some of these. And the first one is overconfidence, and that simply is overestimating our own abilities. And this comes not just investing, but in almost area of life. We think we're smarter, nicer, and better looking than the average person. And in fact, and one study is really interesting. I'll just ask you right now, how many of you would say you're a better than average driver? Raise your hand if you think you're a better than average driver. You're being very humble. Actually, in the study in the US, 80% of people raised their hand and said, I'm a better than average driver. So it does come up in almost every area of life. Who wants to be average, right? We want to be. We want to think of ourselves, of course, as being better than average. But how it plays out in the investment world is quite interesting. Behavioral science is a bit of a new field in the scientists, and this is a landmark study that was published in 2000 that really started shedding light of how difficult it is to be a disciplined long-term investor and to fight some of these biases. And this is one that was done by University of California, Davis, and they took a look at DIY investors, do-it-yourself investors. We might call them SMSF investors today, but back then, it was the DIY, do-it-myself investors. Don't need advice. I know how to manage my own portfolio. I'm confident in my ability to choose my portfolio and trade. And as you can see, the more active those investors were in trading their portfolios, in terms of the turnover increased in their portfolio, they're more actively trading, the worse their performance was. And this is just a look back over a 10-year performance from 1990 to 2000. And in fact, the more actively the investors managed their portfolio or traded their portfolios, the worse they did, even just compared to the broad benchmark, the S&P 500 index. And it led these researchers to actually name their research, trading is hazardous to your wealth. So that started showing us some of these biases that come in. Another one is confirmation bias. This is being very anchored in our point of view. This is being very anchored in terms of our beliefs. Maybe it's about a company, a sector, that we really feel that, I really need to be in this particular part. This needs to be in my portfolio. How many of you hear that from your clients? Really confirmed in that. And that comes up in the fact that it's so easy when we have that strong confirmation bias to go out and research and to seek information and magically find information that supports our point of view. It's always the way to find information that supports our point of view. Most recently, just outside of the investment world, we've all heard how important Facebook has been, particularly in the US election. Did you know today over 1 billion people check Facebook around the world? And what now has been done in terms of retrospect in the US election is really noticing the impact, understanding the impact Facebook has had in the US election. Tens of millions of American voters got their news almost solely from Facebook. And if you use Facebook, the more things you like, the more things you comment on, the algorithms are such that it will tend to show you more of that very thing and reinforce your point of view. And there was one study a colleague of mine told me about, which was really interesting, a small study. And they took 10 people, 5 people who were going to vote one way, 5 people that were going to vote another way in the US election. And in the last month of the election, they said, would you switch news feeds and read for a month leading up to the US election the other person's Facebook feed? And how do you think they did with that? 2 people dropped out of the study out of 10. 7 people found it so uncomfortable they couldn't wait to get back to their own news feed, and only 1 person said, this might have opened my mind to something different. So we are anchored in our beliefs, and that comes true so much in terms of how we think about our portfolios and investing for the long term. Another one is actually recency. We tend to overweight recent information. Again, recent returns, we saw that. Chris Galloway showed us that great chart that actually showed how money follows performance, right? We chase returns. And also how important it is for us, we know this as investment professionals in our industry, that knowing this, how important it is to frame up information to investors so they have a balanced view and they can actually make smart decisions. And this is a study that was again done in the US. It was actually for US retirement plan savers that are choosing their own asset allocation. And if they were shown one-year distribution of returns in the stock market, in the share market, and they saw that volatility, they tended to weight less of their portfolio towards the share market, to the stock market, only 40%. But if they were shown a more holistic picture of a 30-year distribution of returns, then you can see that they allocate a lot more to shares. So how we frame up information as advisors, as in a financial services industry is critically important because of this bias that we tend to overweight the last bit of information we heard or that we read. And then finally is herding. Now this is probably the most common behavioral bias. We've talked about it a bit here. You've heard a lot about how our investment philosophies are designed to actually avoid that tendency, that hardwiring to want to follow the herd. And that bias is really that fear of missing out that we all have. Now, I live in the inner suburbs of Sydney. I know I don't sound like it. I'm from the US originally, but I've been living here for 12 years. And I live in the inner east. Did you know the price of a one-bedroom apartment without parking in the inner east is now over $1 million? And you cannot get in the door in those open houses, in those inspection times. If that's not hurting, I'm not sure what is. Who knows what will happen? We're not guessing. But that's that fear of missing out, right? That's the herding that we have as humans. And you've heard a lot from our investment team how so much, again, of our philosophy and valuation-driven investing is about this psychology and is about avoiding following the herd and really staying true to the principles and fundamentals of how we believe in managing portfolios. So again, if there's one overarching lesson I hope you take from this, just this short introduction, short talk about behavioral science, it's this, is that we are hardwired for some of these biases. And it doesn't matter if you're Daniel Needham, it doesn't matter if you're one of your clients walking in, we are all simply human. And if we recognize those biases, we recognize that emotions can often overrule logic, then again, we can work in clever ways to help guide our clients beyond just setting a portfolio that's built to last, but other tools that we're going to introduce you to now. So we believe, again, your role is critically important, that combination of holistic portfolios and being a great behavioral coach. Together, we can create better outcomes for people. So to introduce you to some of the tools that are in your Simple But Not Easy guide, I'll hand to my colleague, Regan Van Berlo. Thanks.